Hello and welcome to another edition of Deal Hunter. I'm your host, Mitch Flax. Alongside of me, Tom Staub. Always good to see you, sir.
Yes, sir.
And always good to see you, Mr. Rob Anderson from BV Capital. Thank you so much for joining us today.
Thank you, Mitch.
Man, a lot of inquiring minds want to know. I'd love to hear the thoughts coming out of BV Capital, what you guys are thinking in this environment. I recently just saw the post that you threw up on LinkedIn that we're in a cold, that the real estate industry isn't necessarily, sick, but we're in a cold. I like that. I don't know if that's because you're in a cold and you're all sniffly.
No, that is true. Hopefully that don't come off that way. But everyone thinks we're in this massive real estate bubble. This is not 2008. I was trying to illustrate that. This is there's a lot of differences there. If you want to get started with that, we can. One thing I really like to point out to people is the inflationary effect, right? So home prices have gone up a lot, but they're only up about 2% higher than their relative to their replacement cost. People don't take into account the replacement cost. That's important whether it's commercial real estate or residential real estate, right? And that's what inflation does, is it raises all of that. So as your replacement cost goes up, so does your house or the building or whatever you're doing. And that's where I think a lot of people have missed, because the cost of just materials and labor that go into replacing that. What we'd love to do is brag about if we're able to buy something below replacement cost. To us, that's a good buy, especially in the commercial world, right? And so people see these rising home prices and think, oh, it's a bubble, it's a bubble. Well, what's pushing the price is the rising replacement costs. And that's where I think a lot of people have missed. So we really think that our price is going to continue to go up. No, I think they're going to, well, it depends on what market you're in, right? But they're going to stabilize, but what's going to continue to go up is rent. And there's a lot of differences between this time and 2008. We don't have this massive overbuilding that we had back in 2008. If anything, we have an underbuilding that's happened prior to right now. So it's a very different environment.
Do you think building has actually slowed down at this point?
Yes.
Oh, yeah. Big time.
Yes, it has.
Do you find that it's because money is scared? Are we waiting it out? Or what are some of the reasons perhaps why investors are sitting on the sidelines? And is that perhaps because of the LPs are sitting on the sidelines? Capital is drying up for the GPs?
No, I'd say it's more the debt markets. Deals are more expensive. They're harder to finance. You'll always find people who want to invest. Now, there's a group of people that are a little nervous for sure, but you're always going to have that. In a raging bull market, you're going to find people that are nervous. So I'd say it's more the financing cost.
Yeah, Mitch. I mean, I'll tell you, I talk to builders all the time, the nationals, the local guys. There is no way in hell these guys are going to be back to 08 in any risk whatsoever. So basically, frame or before, pause. Right. So, and a lot of the supply numbers that we're seeing include those homes that are 30% of the way built. Right. And if you go to Zillow and you see what's out there in the market for the supply, it's basically these dilapidated houses from the 70s and 80s that no one wants because they require work. You really can't find a quality product in the market today.
You bring up a great point. I think that's definitely one of the things that I'm seeing, that quality and location matter more than anything right now. And I think, those three laws of real estate, where it's the first one, location, second location, the third location, I think that really is coming more into play, because ultimately folks were kind of forced out from where they wanted to live. And now perhaps it might present an opportunity for them to live in. But Rob, talk to us about some of the areas, perhaps geo-specific, perhaps industry-specific, of the things that BV Capital is really interested in. And perhaps conversely, what are you not interested in? Perhaps there's, areas that you guys might think that might be a crowded trade.
Sure. We are still incredibly bullish on multifamily. Let me give you guys a statistic and tell you why. So in 2018, the average cost to rent a place, just average, was roughly $1,200. In 2018, the average cost to own a house of similar means of what you could qualify for was $1,200. They were identical. They were the same. Today, That same rent is $1,350, but that same cost to own is $1,800. And that's why, back to that post we were talking about earlier, you're going to see massive rent increase to catch up. The equilibrium is where it should be. And what happened was, when the cost to own is so high, people can't buy, they can't finance, they're going to stay in the apartments, and landlords are going to continue to raise rents. We've raised rents 5 times this year. And so you're going to see that continue, because we don't think that asset values are going to come down in the housing market because of what we just talked about. So rents will have to come up to meet them. Well, that means it's a great time to own rental property, whether it's individual or multi. And so, being a developer of multi, we're very bullish on that.
Yeah, Rob, let me ask you a question. Not related to multi so much. I mean, it is, I guess, in the byproduct of it, but I have a theory that as builders pull back on the supply in their building, and as we come out of this, who knows, 2024, we're going to be in a worse spot from supply than we were going into it pre-March, pre-February. What is your take on future supply in the market?
I think you're right. Yeah, I mean, look what happened in COVID. We quit building stuff, and then that ended on a dime, it felt like, and everybody wanted to rush back in with this massive inflation for all these reasons we don't need to get into, and we didn't have the supply. We didn't have the product. Well, what's going to happen? The Fed raises rates, what they're doing. All the builders say, oh, we got to put that on hold, right? All of our friends in the mortgage business are getting laid off, unfortunately, and all that business is just drying up, right? The people are still here. They still want to buy the home. So when rates come back down, they're going to be flooding the housing market, and there's not going to be a lot of supply. And so you do have this exact risk, Tom, that you're talking about, right? It's just simple supply and demand.
Yep.
That's assuming that our economy is where it is today, and the consumer side of the balance sheet looks as good as it does right now, because
Correct.
Things can quickly change. So, that you bring up a great point. I mean, I definitely love the multifamily space when you see the difference of what it costs to own the very same unit or home as it is to rent. And so that equilibrium, it may not go up to the 1,800 that you say, maybe it does, but maybe it finds a middle somewhere there with the amount of supply. I don't know. I'm not smart enough.
Yeah, and Mitch, I do think prices could come down a little, but nothing like what we saw last time around. Last time around, they came down in some, 25% on average. Some markets a lot worse. Do we pull back 3 to 5%? Sure, that would be healthy. Is it going to do what it happened last time? Absolutely not, for all the reasons we just talked about. But they've got to get closer to an equilibrium point.
Yeah,
so how long does that take?
Yeah, sorry, Mitch. I was going to say Poison Ivy, or Ivy Zellman, as she's known. She came out and said, year over year, 3 to 5% price reductions. So that's a total of 8 to 10% over the next 2 years. So,
is that Austin or is that national?
National. So yeah, it's obviously sub-market, right? But
it's coast, your hotter markets, like where you guys are in Austin, you may see a little bit more of it. The more run up, the more run down. We saw that in California last time around. But also, guys, the other thing is, keep in mind that we always play in, everything we do is in Texas. And I know that that's true for you guys for the most part too. And the massive in-migration we are still happening is not going to stop. In fact, this may even make it worse as far as just the amount of people moving here. A company can move here overnight and they save 8% right off the top, depending on where they're coming from, right? That's not stopping. Not to mention the oil and gas business has done exceptionally well because of the price of oil. That does affect a lot here in Texas. So there's a lot of things happening that here we're not going to see. And I'll give you another thing. On the multi side, buying now may not be the best times. That's why I mentioned earlier, if you already own, that's one thing. So we have, Mitch, you asked me what have we done? We pivoted almost exclusively to construction because the margins are so strong in construction that even with the higher debt cost, you can still make a ton of money for investors, and you're still fulfilling a massive need out there and delivering brand new product in the right markets. And so you asked, before we got on this podcast, you said, what are we doing? That's what we're doing. We've almost shifted exclusively to construction, to ground up, and just supplying that need that's out there.
This is what I've been saying forever. How else do you either build an incredible buffer against a downturn by building yourself, right? If you're a single family developer, or even, a homeowner who wants to get access and raise a family, there's no other better buffer against a down market or paying less than retail than building a home yourself. Now, you're going to have some challenges, a lot of headaches. You may start to lose your hair. I mean, there's a lot of negative things that do come along with building a home. However, financially, it makes a lot of sense. And a lot of people don't understand that the economics of building a home, it's not as rich or as costly as you would think. There are a few lenders out there who will lend on what's called a loan to value. So they'll actually take your appraised value of your completed home based on comps, which right now they're all lagging. So you're looking at, better numbers. So you take that, factor that into your cost of build. And I think you ultimately, that translates into the market that you play in. So you're building out there, specifically multifamily. 12 months ago, you did a student housing deal with TCU and University of Texas, Arlington. And I absolutely love that deal. I love the student housing deal. Anything else like that you guys are looking at, and, or other spaces that are kind of multifamily, perhaps just labeled a bit differently?
Well, we are about to do a multifamily near another university. What's interesting, and this is all local, so depending on who's watching this and where they live. So in the state of Texas, UT and A&M are full, right? They cannot even admit more to their main campuses, let alone you got to be in the top like 6 or 7% of your class to get in. And so what's happening is everything else is where the student populations are going. And so what's also interesting is those two schools, satellite campuses, are where they're having their students go to. If you look at both UT and A&M satellite campuses, they're exploding. And so we're about to do a ground up multi next to Texas A&M Corpus Christi. Since you brought up student housing, there's 12,000 kids there, and they're trying to grow that campus to 20. So not a big market, but once again, it goes into that whole idea that they don't have the housing, but yet they're going to bring all these kids in. Where are they going to stay? And a lot of times they're going to these satellite campuses with the goal of moving to the main campus, and they never do. It's really interesting. So our UT Arlington property is a similar example of that. It's really fascinating what we've been able to see there. So you're going to continue to see the constraints at the college level, because it's just housing overall, whether it's single family, whether it's student, whether it's multi, whether it's senior living, we are underhoused. So you pick your poison.
All good points. One of the things that you brought up a few minutes ago was replacement cost. What about replacement returns? So what I mean by that is you've got an asset that you've held, you've owned it at a great basis, and you promised investors perhaps a 3 to 5 year hold. You're coming up on that 5 years, and you're thinking to yourself as an investor, well, where else am I going to put this money? And perhaps, that's me from an LP perspective, you from the GP perspective. Obviously you want to deliver for your investors, and some of them may need liquidity, but I'll imagine that most of them are saying, hey, Rob, should we hold on to this thing for another 12 months and kind of reevaluate where we are? Is that something that, BB Capital is perhaps anticipating as you guys start to get in that time frame of, having to dispose of these specific assets?
Well, there's two sides to that, right? Is the market going to get better or worse from a institutional buyer perspective? Or, and that determines what you do. We do have a few assets that we are contemplating holding longer, to answer your question, just because the yield is so strong relative to what would happen right now. The shorter answer to what your question is, what developers can do is called a recapitalization. They can basically redo their capital stack with new money and allow people to either stay in or allow people an exit. And so they kind of redo their deal. And a lot of times this is done with a refinance. So maybe right now is not the best time, but that is something that's happened. We've done it before, and you may see more of that. going forward as some of these get longer and then people decide, hey, our PPM that we offered you said we're going to exit in 5 years, but half our people don't want to exit. They've got to figure out a way to do that.
That makes perfect sense. One of the things you bring up, obviously restructuring finance, and obviously right now, probably not the best time. I think a lot of GPs out there, specifically in the real estate space, would look to build, look to recap through refinancing their debt. And obviously with, that really isn't possible, or perhaps it is. I don't know where you're getting that debt from, but maybe there's a fairy out there that is giving you some incredible rates, but I haven't seen anything of late that would make me to believe that the rates would be better now or in the near short term than they were 12, 24 months ago. I mean, that's obvious. But let me ask you this. I mean, there are a ton of real estate managers like yourselves out there, and I think the proliferation of, the crowd streets and the realty moguls, the yield streets out there. What do you think really separates BV Capital, not just in this environment, and please lead with that, but just overall the internal structure? How do you evaluate a manager other than looking at what their forecasted returns are?
Yeah, well, and you can't look at forecasts. You got to look at the track record, right? What I would tell you are the 3 shops that you just mentioned, they're not real estate developers. They're placement agents. And there's a big difference. A placement agent isn't going to go out of business if the deal goes south, right? Their own money's not at stake. If you're a placement agent, that deal goes south, sorry, next deal, that's what happens. If you're the developer, you're the issuer, like Tom knows this, right? If that doesn't work out, and you got, not only did you lose a lot of money, you got the reputational risk that you can't afford to have. I tell people, one bad deal, you're done. You just can't afford to have that happen. So who you're working with and how directly you are to the action is super important, especially today.
So what else specifically, because obviously you're right. I mean, they act as a broker dealer. There's some criteria that these firms obviously go through to get, to find the deals, right? I mean, there is a checklist and some due diligence, and obviously they don't necessarily feel the effects if there's a dog in there, right? I mean, so the interests perhaps aren't aligned. I certainly love what they are doing in democratizing real estate investments for the average investor. I do like that. And I think it can be helpful. But one of the things it also does is, we talked about this a little bit before, is that it creates perhaps a crowded trade. And now with these crowded trades, you've got a lot of unskilled or less skilled fund managers coming into the marketplace that perhaps could, be detrimental to the overall business, right? You think of everything about the public market world, and, when any of these scandals has happened, they affect everyone. It's almost kind of like that bad apple rule in our old world, right?
Yeah, Mitch, Rob, let me ask you this. So are you primarily positioning your deals in the urban core? Are you on the fringe? Where are most of your deals placed?
You couldn't even categorize us.
Okay. So yeah, because I'm curious, because, what I'm seeing, because ours are kind of on the peripheral of the MSA. I've seen debt still flowing, equities mostly still flowing. The one question mark I get a lot now, a little more hesitation, is we prefer for you to be closer to the urban core given the markets. They're a little more hesitant to be on the outside. Are you seeing that same sort of hesitation, or what are you seeing from the investors or the debts?
Well, keep in mind, we've already locked in all of our debt on everything we own. So it's probably not the best time for me to answer that question, Tom. So we're not necessarily seeing
That's
that.
fair.
We've got stuff that is literally in the urban core, and then we've got stuff that's considerably far out and even considered vacation. So, it's just, once again, when you're doing construction or land development, the margins are so good that you can afford a little higher rate in the short term. So it hasn't really touched us per se. That's a harder one for me to really answer because everything's locked in already for us.
Got them on one, Mitch. I got them on one.
Rob, it's always great to have you on and give us some insight. Anything specific you'd love to share with perhaps might be coming without getting too specific from BV Capital in the short term?
Yeah, we still have ground up. We're still chasing land. We're going to take land down with our investors, and then we're going to finance the construction by donating the land to the deal. That's one way we get financing done, Tom. So we own our land debt free, and then we have a lot of construction deals we probably have 6 or 7 that we might launch within the next 6 to 9 months. Just to give you an idea, we're staffing up our construction company right now.
You poor soul.
Yeah, we gotta get some easier access to labor. There's no question about that. So, you know
what? One thing I was going to tell you, Mitch, you were talking about just a crowded marketplace. I didn't really answer this. You're seeing retrades happen. You're seeing some deals fall apart. You're seeing deals fall out. There are people that had either existing properties or land under contract, and they can't get the financing they're wanting. To Tom's point, maybe it didn't meet the metrics that people are asking right now. And we're finding a lot of those because a shop like ours can go get those, and we can help salvage that for somebody. That's creating opportunity. So I'm actually going to say I think we're going to have a less crowded marketplace the more this continues.
I agree with you. Well, man, thank you so much. Go feel better. By the way, if you didn't tell me you had the sniffles, I would have never known. So thanks again, my friend.
Thanks for having me, guys.
Yep.
Take care, Rob. Tom, really interesting stuff coming from Rob as always. And you look at kind of the ground up multifamily space and ground up development overall in general. I think that kind of shares some similar sentiment to some of the same thoughts that you've got at Red Oak on the single family side.
Yeah, I mean, I think if I were selling my lots and my stuff right now, I'd be in a tricky spot. Builders are definitely doing slower takedown schedules. Most of the guys I talk to, the DR Hortons, Lennar, Century, Braun, they're thinking 2024, 2025. These next 12 to 18 months is kind of a moot point. They're going to slow down. They're going to renegotiate where developers were aggressive. We have our 7 scenario underwriting. If we hit our high, we don't feel the need to go any higher than that on negotiations. Well, we, I guess, underprice ourselves. However, the good news is no one's backing out of our deals. So,
Tom, what is this 7 scenario that you just mentioned? I'm interested in this.
Yeah, I have OCD to the max, and I'm so afraid to lose money that, again, it's a standard sensitivity analysis on low, mid, high. We then have a crash scenario of a 20% devaluation in the land, everything else. And then our 7th scenario is if we can't get financing on the horizontal, then we have to do it as just papered lots, right? So every scenario has to make money. Our crash scenario has to make an 8% margin or above. Our target margin's around 25-30%. So if we're hitting all those metrics, and when I go to market, and I shouldn't be telling this because here's my strategy. I negotiate my high scenario with the builders first, and I know it's viable all the way down the low. Well, when it was hot and heavy, we were getting no pushback on the high scenarios, which tells me I left a lot of meat on the bone. But right now, it's to our advantage because no one's backing out because our prices are the best. And by the way, a lot of these builders have been told by their corporate headquarters in Denver or New York, or wherever it is, no more self-dev. You're going to buy lots from developers, entitled or developed. Well, newsflash, there's not many of us, right? So it's good news for us in a market where the lot supply is crashing. And again, going back to what Rob's point, I think supply is going to be tough coming out of this in 12, 18 months.
Tom, do you see being able to sell paper lots to the developers, or are they backing out from that entirely?
No, I mean, so I don't have any paper lot deals. I've always assumed we had to go full ham, right, all the way through. But they're shifting because 85% of their book is their own self-div. Well, they still have quotas. They're publicly traded companies. Right. So they have to pivot, and they're willing to take on entitled lots.
We've seen that. That's why I asked. I was curious if you're seeing that.
Yeah, there's definitely an uptick for sure.
Tom, you brought up an interesting point, because one of the deals I remember that you structured 12 months ago that I had a hand in bringing one of the builders to the table. We talked about pricing per lot, and perhaps you could have got more. And had you gotten more, maybe they would have had a little buyer's remorse today, where they perhaps may have been forced to back out just because the economics and numbers just don't work. Have you seen any of the home builders that you're doing business with? Have you seen them at all have any inclinations of doubt or talk to me? Are they thinking about pulling out?
Look, if you look at the numbers, Lennar took the first bite, right? They've seen some pushback on their positions. DR came next. So you're seeing some drop off from DR for sure. Century's feeling a little bit of pinch right now. These are all the move up or entry level builders, right? You talk to Toll Brothers, the Drees, the Weston, GFOs. I mean, they're seeing lower traffic, but they're doing fine as well. Their margins are still very strong.
Their stock stinks.
Well, hey, if I weren't a believer in putting my money elsewhere, aside from my main wheelhouse, I would probably invest in some of them. Their margins on the accessories and the upgrades are like 45 to 50, like 48%. I mean, it's massive for those doors and cabinets and wine cellars. That's where they make all their money. They're making roughly 20% on the home 25% collectively. So the home itself as a spec is not the most rewarding, monetary, piece of it. It's really all those little features you add on. The $2,000 fan that's hanging above my head that my partner had to have, that's where they make all their money.
That's true. It's all in the little stuff that starts to add up. Well, hey, a great session. And Rob, thanks for sticking around. We said goodbye to Rob and he's just still hanging around. And I'm glad you asked that question, because it was definitely thoughtful. And as always, it's good to see you, Tom. Appreciate the insight. Thank you, Rob, again. Until next time, we'll see you.
Thanks, team.